Welcome to a new trading week, and hey, Europe's still alive. The euro is still intact for now. And by the way, I don't say that making fun of the Europeans. I mean, folks, there's problems in many countries. Europe is not immune to it all. It just happens to be the market's focus happens to be on Europe right now, but come next quarter, maybe 2013, sometime soon, you got to think the U.S. is going to be under the spotlight, and who knows, maybe Japan eventually hits the spotlight. There's been some plenty of talk over the years about Japan's fiscal situation, how it seems to be unsustainable, but Japan's been able to keep it going, but we'll see how long the Ponzi scheme can last. Anyway, welcome, folks, to the latest rendition of my series of webinars at Epic Street. Thank you very much to everyone at Epic Street for making this event possible. Thanks to each one of you as well for your attendance, for your participation, and every once in a while I'd say to kill me, you guys always ask smart questions and make very, very valid comments. I appreciate it all. Keep coming. First, let me remind you the purpose of this event is education. I'm not going to provide specific trade alerts or trade recommendations. We will take a look back at how this trading day unfolded, and we'll take a look ahead at what the upcoming day, being tomorrow, the 29th of November, Tuesday. Also, I'll take a look of even further out, just beyond tomorrow, because folks, maybe just me, I'm not one to dramatize things, but I am increasingly getting a sense based on things like what other markets are saying in terms of price levels or yield levels, based on the attitude of the likes of economists and the media and traders and such, that we're looking at the edge. We're peering over the cliff when it comes to Europe. Either things are going to turn around soon, or things could turn ugly soon. When I say soon, it's we're not talking months, we're talking weeks or even days. So keep your A game up and keep sharp, and it could be a very interesting end of the year. Very interesting. Maybe that, or I'm responding to Gam's comment. Either China's seeing an opportunity to pick up some things cheap, whether it's bonds. I haven't gotten a sense yet that China's that interested in helping backstop Europe too much. I mean, a lot of the tone of a lot of the comments from China lately has been, Europe needs to fix Europe's problems. If anything, what China may be interested in, and maybe again you could expand upon this if you've seen something more recently that I've missed in terms of media reports, but one thing that China has been interested in for a long time, I mean, just like for example over the past several years, is acquiring assets on the cheap. Assets that especially resource-driven assets, but even beyond that, China, for the right price, can might. I mean, I'm talking about tangible assets. Yeah, Marco, you make a valid point, but especially in the U.S. But again, the idea may be that maybe should the U.S. should pony up first and show some investment in infrastructure, and China could partner in that. But anyway, I want to get to the charts here. As is often the case these days, my focus is on the euro, and why not? The euro is the most liquid, the most heavily traded currency pair on the planet. It's been showing decent volatility, moving fairly well. I don't know how many of you folks realize that. How many of you were involved in the currency market, either just practicing on a demo account, maybe watching the markets, maybe trading the markets with real money back in 2005, 2006, for example, even before that. When I first started coaching at FX Bootcamp, this was in May of 2007. It wasn't then, but it was soon after that. I recall ranges on the euro, average daily ranges on the euro, about 60 pips. I mean, we got down to a point where the euro was averaging for a run of about 20 days, about 60 pips from high to low for the day. I mean, that was it. That was it for the euro. And of course, this was just before the U.S. subprime mortgage crisis kicked in August of 2007. Really, ever since then, the volatility has been more up than down on the euro as this whole global financial crisis unfolded in different corners, and different currencies have benefited or weakened, or as life has gone on. But anyway, Yeah, volatility has been at times extremely low on the euro in the past several years, but not so more recently as the U.S. subprime mortgage crisis took hold, and of course then you had to unwind the yen carry trade and yada yada. My point is this: there may be some of you that have been scratching your head thinking, why is he focused so much on the euro? Well, yeah, number one, the euro moves very well. Number two, it is a very heavily traded currency pair. So, as a trader, one thing I always seek is liquidity. And by the way, that's something a lot of investors and traders seek is big markets that are traded fairly heavily, markets that move fairly logically, fairly predictably. And the euro has been doing, in my view, just that, moving very technically very well. I mean, there's certainly been some days when the euro has been a real head scratcher. But that's true of many markets, not just in many currency pairs, not just the euro USD, and not just the currency markets. Well, and the other main reason for so much focus on the euro is I can't be the only one who gets this feeling that we're watching history unfold. I've been telling our members at FX Bootcamp that I felt almost an obligation to try to, in my own little way, document history this year when it comes to the Eurozone, because either this the beginning of maybe the darkest of days and the eve before we see better days for Europe, or this is the beginning of an historical change in Europe. And I just had the sense that I'm sure there's plenty different journalists and even some hedge fund managers and bloggers and such all documenting what's happening in Europe, media outlets. And in my own little way, I felt like this sense of that there's a lot to be documented in terms of the history of how the Euro USD itself has moved over the course of the past several months, and how tradable it's been. And given all the uncertainty that surrounds day to day or even week to week, what's happening in Europe, what could happen in Europe. So anyway, enough of that setup there. Let's look at the euro charts. So some of you noticed the gap between Friday's close and today's Asian session open. That gap has never been filled. Anyone have questions about gaps and trading them? I for one, rarely will seek to trade a gap. I know some traders at Bootcamp, even a coach or two at FX Bootcamp, that really get hyped up over gaps. I've never been a big fan of gaps. The idea behind a gap is this. Many traders have come to expect that when you see a gap between the close of the prior trading week, the Friday close, and the open of it's Sunday in the North and South America, but it's early Monday in the likes of New Zealand and Asia, the open of the Monday Asian markets. Many have come to just adopt this mindset that the gaps got to be filled. Yeah, sometimes it is, but many times it is not. It can go unfilled for days, even weeks. So that gap between Friday's close and today's early Asian session open has not been filled on the euro and many other currency pairs we saw gaps on. Well, anyway, you can see in the right-hand portion of this 15-minute chart, I'm going to zoom in on this chart a little bit. You can see a rally beginning in the early part of today's London session. And you can make a case for support around 32.80-ish. You can see some early Asian and middle part of the Asian session, some lows around 32.80. I've just added a horizontal blue line on this chart. Let me make that blue line a little thicker so you can see it, and also pinpoint the price at 80. There we go. And right at about the open, just before the open of London session, around 3 a.m. New York time, the euro kicks off, and that was one of the early trades on the euro today, buying at support, what's been Asian session support, and around the open of the London morning session. Now let me zoom in on this chart a bit, and we'll talk about another scenario here. As I fix this chart, let me discuss some things with regards to some reasons based on the news flow why you would seek to buy the euro around London Open beyond technicals I just mentioned, and instead of, say, looking to sell the euro. Well, some of you may have caught some news flow over the weekend. One report that caught my eye was there's been talk of what's called fiscal integration in Europe. Some ways that the German Chancellor Merkel and French President Sarkozy talking about discussing ways there can the European countries can be, the Eurozone countries can be a little more closely knit fiscally in terms of their budgets and such. And maybe eventually we'll see formation of a common treasury department for Europe, and a number of different things are being discussed. So let me simplify this. One of the ideas expressed over the weekend is that in regards to fiscal integration, the idea is this that European leaders, the perception of the market, right or wrong, could be that European leaders are stepping a little bit closer to fixing Europe. Now, many of you probably think that's a stretch, and I'd have to agree with you. We've seen this routine play before. Well, we may even see it again in the days and weeks to come. Anytime European leaders appear to be making a step in the direction of fixing Europe, or at least making things less bad, the euro has tended to recover. So that could be part of the story for today. The idea that we have some signs of a step in the right direction. Maybe some of the key European leaders, like the ones in Germany, like the ones in France, are coming up with some ideas, or further developing some ideas that could, if implemented, if agreed to more broadly, could help Europe. That's one simple idea. Another arguable idea, and this is one more technical in nature in terms of not just the euro but financial markets. Maybe markets were simply oversold. I mean, not just only just when it comes to the euro, but if you look at, say, European bank stocks. I mean, there's some big banks in France, big banks in Germany that were just so heavily oversold in recent weeks. And there's some names come to mind for many of you. There's BNP in France. There's a Deutsche Bank in Germany. I haven't checked Deutsche Bank stock in the past hour or two, but last I checked, this was a few hours ago, Deutsche Bank was up like 9% on the day. So there's the argument that even the bank stocks were oversold, and maybe we're seeing some short covering on, and maybe even some early buying of European bank stocks, with the perception of maybe these bank stocks are being, some of these are being bought by the likes of hedge funds, among others, on the cheap. Another plausible explanation, which I tend to gravitate towards, not as a sole factor, but as a notable contributing factor, is based on the calendar. Does anyone know what's happening tomorrow? There's a certain meeting being held tomorrow, and we've seen these kinds of meetings many times before, even this year. There's a meeting tomorrow. Can anyone recall what that meeting is? And while I wait for the answer, I'm going to catch up on some comments. I haven't been scanning many of the comments. And by the way, thanks all of you for your comments. So Ganster, I see your question about take on China lending to Europe. I don't expect the Chinese to be too eager to lend to Europe without something in return. Again, I do not expect the Chinese to be that eager, to be that bold about backstopping Europe or investing in, say, EFSF bonds. That's the rescue fund in Europe, unless there's something in it for them. And thus far, I haven't seen Europe offer anything that the Chinese would find appealing, like, for example, market status, but that's another topic. Yeah, Michael, I saw the Greek 10-year bonds. Did you notice? Yeah, I think it was Portuguese 10-year bonds just hit a new record today. The yield on the Portuguese 10-year bonds hit a record today. Zebra mentions the Euro-Swiss gap. And I agree, Gam, about fiscal integration being difficult. Gam, when you think about anything that's being proposed right now, and be it this fiscal integration, even any more meaningful changes to the rescue fund, which is the topic of Justin Ministers, the finance minister meeting. That's what's happening tomorrow. A so-called ECOFIN meeting. A meeting of European Union finance ministers occurring tomorrow, and the topic du jour, the topic of discussion tomorrow, is going to be the EFSF. That's the European Financial Stability Facility, or the rescue fund that was established in May of last year, initially to just address Greece. And folks, for those who don't know, this rescue fund was established to help backstop Greece and possibly one or two other smaller European countries, the likes of which would include, say, Ireland or even Portugal. But that rescue fund established back then mostly to address Greece and maybe a couple other countries, as well as overwhelmed now, or would be overwhelmed if it were tasked to backstop the likes of Spain or Italy. And so there were some discussions at a summit late last month, late October, about leveraging and ramping up the EFSF, adding some firepower to that rescue fund. And although there was an announcement made there was intentions announced, such as say, to increase the firepower of that rescue fund up to like 1 trillion euros. Notice the euro has dropped since then. So let's go back to I'll get back to the charts in a minute. I'm going to continue this discussion of euro in terms of the news and fundamentals and such. Let me go to So let me pinpoint when we had it was right in here. No, it was later than that. That was October. Let me get my dates right here. I can go back farther than that. That's why I'm confused. There we go. Yeah, there was the big rally. On the upper left-hand portion of this chart, my cursor's hovering next to the big sizable rally in response to the last major summit the Europeans held. And by the way, note that rally found a former black uptrend support line we discussed in advance as prospective selling opportunities. So the euro is clearly down since then. But what's notable here, and what's worth bearing in mind, what's worth keeping in mind as we get into tomorrow and the next day even, is this scenario has played out before. A rise in the euro in advance of a meeting where European leaders meet and discuss, if not solutions, then steps toward some solutions, even short-term solutions for the eurozone. The euro has often, not always, but often enough, rallied, either in advance of or following such meetings. But it doesn't take long. It's taking the increasingly less time for the bears, for the sellers, to reappear and push the euro down following these meetings. And we could be facing the very same kind of scenario this week. So not much of a run-up, a small run-up today in the euro, possibly on the back of maybe, albeit modest still, some expectations that maybe some progress of some kind be made at this ECOFIN meeting tomorrow. But do not be surprised unless there's a real game-changing. I'm kind of stepping ahead into looking ahead and rather than look back at what happened today. But now that I'm on this topic, I kind of want to finish this thought here. And unless there's a real game-changing event, I would not expect any rally either from now until next Asian Open or through tomorrow's trading day. I would not expect any rally to be that long-lived. Would not expect any rally to be that long-lived. Let me catch up on questions, then we'll get to recent price action and what we discussed during my live coaching session today about trade opportunities. By the way, there's a lot. I've been reading about some reports in China about China's got its own problems right now. China may have more fiscal problems than some media and money managers give it credit for. I don't think I've caught up on comments. I don't think there's anything new there. So here's what I discussed. Let me suggest this 5-minute chart for the year. I'm looking at a 5-minute chart for a reason. You don't have to use a 5-minute chart yourself. You can use a different time frame, but I do like looking at a shorter-term time frame. Let me back up a bit. The standard time frame we use at Epic's Bootcamp for so-called spot trades is a 15-minute chart. And there are other time frames we do scan, we do use regularly in terms of formulating trade plans from a technical perspective. But for our standard sort of time frame for a chart for so-called spot trades, where we would enter and exit the trade within the course of a given trading session or at the most a trading day, it's a 15-minute chart is pretty much our standard at FX Bootcamp. You may use variations of that, but that's what we use at FX Bootcamp. And as I hear it, it's fairly common throughout the retail foreign exchange trading industry that the 15-minute chart is pretty common. Well, I like to still scan from time to time at a shorter term time frame, like a 5-minute chart, for identification of prospective intraday levels of support and resistance. Let me adjust this chart a bit so I can explain to you my thinking that I expressed during my coaching session today. We had, actually I need to back out a little bit on this chart because here's where we were. Let me get my time right here. Yeah, this is about an hour into my coaching session today. My coaching session at FX Bootcamp, I cover what's called a London lunch between 6 and 9 a.m. New York time. And it was about here. I was discussing, along with some members of FX Bootcamp, was discussing, where might bulls step in? Where might traders be seeking an opportunity to buy this pair, assuming that you should see a 5-minute chart. And by the way, if anyone can comment, what exactly was I talking? What exactly was it that I was talking about before you lost sound? If you can recall one of the last things you heard me say, I can try to jump in from there. But the best thing I can do right for now, and especially given the little more than 15 minutes we have left in my scheduled time here. London Munch, where the bulls step in. So you caught about as much as I was hoping you would have. So we were talking about buying opportunities based on some of the things I mentioned before. The sound got caught off before you lost charts. Probably it's worth a little more explanation on that besides what I've already. So let me review some of the things that not only that I've discussed before you lost sound, but even a couple of things I haven't even already mentioned yet. So. So a couple of things surfaced over the weekend that, maybe the Europeans are showing signs of at least very, very modest progress. Whatever the case, whether you like it or not, whether you believe the European your leaders are going to get their act together or not, this is what the euro has tended, even when there's baby steps of progress being made, that the euro tends to recover. So you could argue it's a short covering rally, but nevertheless, that's often what happens, and it happened today. So great. I mentioned a recovery in European bank stocks. That's, if anything, is euro positive. The broader European equity market indexes, like the DAX, like the CAC 40 in France, those are all up today. That's a euro positive, if anything. What struck me, and I'll get to this later, but I want to touch on it now. What struck me, though, was that I didn't see much in the way of a drop in yields on, say, the Italian 10-year and the Spanish 10-year. I would have been more eager as a bull had we seen a notable drop in yields relative to where the yields on, say, the Italian 10-year and the Spanish 10-year have been. But I'll get into that in a little bit. So just keep that in the back of your mind. But anyway, the risk-on mood we've seen in multiple financial markets, European bank stocks up, among other things, and so you had even the U.S. yields were up a bit. So that risk-on mood could give you at least part of the basis for looking for a long. Another reason for thinking long, again, this is often what happens, as I discussed a moment ago. This is often what happens on the eve of a European Union type of summit. There's just some expectations that maybe some progress will be made, or maybe the fear amongst the bears that some sort of a big bazooka type solution might actually be announced, sort of surprise positive sort of thing. So short covering can be the theme of the day on a day like this before on the eve of it. So there's some of the reasons we were talking about long. So now the question is where might bulls be lurking? Where might buyers be looking to jump in? Well, I've got two blue arrows on this 5-minute chart, and again, one of the reasons I focus on a 5-minute chart, I find it easier to look at a shorter time frame like a 5-minute chart, maybe a 3-minute chart, to identify evidence that can give me reasons to believe at a certain level will be support or resistance. Well, maybe it's just me. By the way, let me add one more line in this chart, and then I'll zoom in a little bit on this. some traders in our room were talking about 33.30. Let me add a line there right now. I'll make it green. And part of the reasoning behind 33.30 possibly being important, today's Asian session high, which my cursor is situated next to now. So there was some talk amongst the room that I mentioned. I think before you lost me on sound, I mentioned two different camps. I don't know if you heard me say that or not. Two different camps. I was in sort of on a minority camp, saying that we could see a balance of 33.50 for reasons I'm about to explain. Another camp was citing 33.30, basically in part on some of today's Asian session highs. So let me zoom in on this chart, and let me talk about why I thought 33.50 could be important to some wannabe Euro bulls. And we have to go right here. First of all, I could apply a Fibonacci study to today's London session rally. Let's do that now. So no, you can already see a 38.2% fib because it overlaps with that 33.50 level. So the 38.2% Fibonacci retracement level of today's London session rally, that's represented by a horizontal black line, which is a little difficult to see, but it's there at 1.3350. Now, again, going back to those blue arrows I just mentioned earlier, what I was talking about was that if there was one level, there was one area, one area where the euro seemed to hesitate the most. So what I'm looking at is this London session rally, and my cursor's hovering along right now. Today's London session rally, if there was one area where the euro hesitated the most, it seemed to be around the 33.50 area. The actual top, which I've highlighted with one blue arrow, is closer to like 33.60 or just about 33.60. But, this is one way that price action responds to a prospective level of support or resistance. Sometimes you'll see a pair like the Euro-USD, for example, form an exact top or bottom at an important level, or it can straddle that level. In this case, you could argue that the euro straddled the 1.3350 area for a while, and straddled that area more so than it did any other level during today's London session rally. And at the time, we had some moving averages on the 15-minute and hourly charts approaching the 33.50 area as well, about an hour or so into my coaching session today. And you can see as I advance the chart forward in time, we had noticed that we had even more hesitation, a longer period of hesitation around 33.50 in early New York morning session trading than we did hesitation during the London session rally. And if I go to the charts with indicators, let me go to that in a moment. You can see how a couple of those moving averages come into play. And as I'm queuing up those charts, another factor I haven't yet mentioned comes into play here as well, and that is time of day. Time of day. There are certain times of day when moves can begin, when certain moves can end, or when moves from, say, prior sessions can resume. When, for example, when London session rallies can begin at least an attempt at an extension. And I found there's two common times when London session rally it can resume. There's the open of the New York morning session, that's 8 a.m. New York time. Another fairly common time, the U.S. equity market open. In other words, the opening bell on the New York Stock Exchange at around 9:30 a.m. New York time. So again, two times when volatility in the currency market, particularly on the Euro-USD, can increase. Two times when moves, say on the Euro-USD, if the Euro-USD does a London session move, when that move can extend or get going again, and that's again 8 a.m. New York time or around 9:30 a.m. New York time. And so let me look at a 15-minute chart here for the euro. These are charts with indicators. Right in here, you have the 15-minute 21 EMA parked around 33.50 at the time. So 38.2% fib. A level which seemed to have some influence on price action during the London session rally, plus a source of dynamic support being the 15-minute 21 EMA. I don't show it right now, but the hourly 5 EMA, often in about the same place as the 15-minute 21 EMA. The hourly 5 EMA was in the same vicinity as well. So that was the case for the long. Now, why? Now you may be wondering, okay, why, technically at least, why did the euro rally stall out? And we talked about the bear case as well. If you're a bear, where might you look to short? Well, let's take a look at an hourly chart with daily pivot points. I'm going to expand that hourly chart with daily pivot points to really give you a good look at what the euro did today. You should see by now, as I've expanded this hourly chart, the thicker red line at the top of the chart. That represents the daily M4 pivot point. That's a classic top, a classic source of prospective resistance on an uptrending day. Now, by no means does any single pivot point always hold. For example, by no means does the daily M4 always put a lid on the euro or put a lid on any other currency pair for that matter. But it is common enough that the M4 can define the top for an up day. And in fact, it happened again today. So we had a daily M4 pivot point just a few pips below 1.34 psychological level. As many of you know, psychological levels can be respected, can either provide a support or resistance. So daily M4 close to a psychological level, but that's not it. That's not all. And arguably, that may not be even be the most significant prospective source of support near 1.34 today. For that, I'm going to go to another chart without indicators. Yeah, this is a chart I wanted to show you here. This is a 4-hour chart without indicators. You should see a downward sloping red line in this chart. That red trend line based on the October 27th high, the November 14th high, the November 22nd highs. I've actually ignored a little bit of a wick from November 22nd, but that trend line connecting those highs, extended forward line, if we didn't top out there at the trend line today, we came very close. Again, I won't disagree with you there in reference to your comment about a new support and resistance line. But do you see why that combination of red trend line plus daily M4 pivot point, I've seen plenty of days on pairs like the Euro USD when that's all you need. A trend line going back several days, a daily M4 pivot point, not to mention a pair that's been in a broad downtrend for quite a while here. And basically that was the short we discussed. So when you wrap it all up, what you had was this: a case for the bulls to buy around 33.50, the open of the New York morning session, 38.2% fib of the London session rally, one or maybe two moving averages near there as well. You got you got a euro rally up some 40-45 pips, at least enough to profit from. You had a decay there where you were, depending on your quality of your entry and such, you at least had enough profit from that long on the euro if you took it to justify locking in some profit. And the case for the bears was simply, a near double, basically a double top around the daily M4, the trend line I mentioned earlier, and the psychological level. So as it turns out, the bears, that is the New York morning session, bears won out more than the bulls did. But there are opportunities in both directions to make at least some profit from today's moves. And I've got 5 minutes of scheduled time left. I may go a little longer than that, depending on obviously interest and of course the approval from FX Street. I'm not going to fill the time just to fill the time, but let's just start with this. Here's what I covered in at FX Bootcamp with regards to the rest of the trading week. Obviously, the same kind of theme I've been pounding in everyone's heads for weeks now applies. Watch Europe, watch Europe, watch Europe. And I mean by watch Europe is, watch the major European equity market indexes. Watch maybe some of the major European banks and how they fare. Watch especially the bond markets. In terms of a look back, one thing I haven't mentioned yet, I just took a look back at today's price action. Well, it's worth noting last this was last Wednesday. I'm sure at least one of you have caught wind of this or heard about this or read about somewhere. Last Wednesday, Germany conducted a bond auction. The German government sold bonds. As many governments do, we see bond auctions, all the time. Not quite every day, but close to it. Germany tried to sell bonds, and they could not sell them all to the investing public. I forget what was the total. Was it like an €8 billion bond auction or something like that? Now, so Germany failed to sell all the bonds to private buyers. Now, what's meaningful about that? Well, it's not the first time that Germany's had a technically failed or technically uncovered bond auction. There's been at least more than a handful of those over the course of this year, and more than a handful of failed auctions over the past 2 years. Last year and the year before, that is. Not the first time, but however, that failed German bond auction was notable in terms of how massively undercovered it was. I mean, there was I think the Bundesbank of Germany, Central Bank of Germany, that is, the Bundesbank had to pick up something like 40% of the issuance of that bond auction. That's pretty high, which I think the historical average is like more like 20 or 25%. So anyway, some signs last Wednesday, Germany's having a little more problem selling bonds. Now, as I mentioned in my New York session video review for last Wednesday, posted on the FX Bootcamp's YouTube channel, also posted on Forex Street's blog. As I mentioned in that video, you could argue that the long trade, those investors who've been long on German bonds, there's been a lot of money flowing in Germany, specifically in the German government bonds, on the backs of concerns about Europe and such. And Germany's arguably the economic strength, the economic core of Europe. And you could argue that trade was more than a bit crowded, so that could be part of the story. However, something very unusual happened that day. The German 10-year yield, as an example, rose, and the U.S. 10-year yield dropped. So Dan mentions yield spread. Now maybe that's what you're talking about. So yeah, if you look at and I actually have a graphic for this provided by Bloomberg.com. Let me post a link to this. Oops, I got to post it again. There you go. The U.S. German 10-year yield spread, not something I refer to certainly every day, but this is something to watch. And what strikes me about this yield spread, and it's not the be all end all of indicators by no means, but what is worth noting at least, if you look at the 5 years worth of data on this yield spread, that unfortunately I had a labeled graphic that I showed in my New York session video review for last Wednesday. I don't have that labeled graphic here, but I can tell you this: that spread or difference between the U.S. 10-year yield and the German 10-year yield, it went negative. It went negative for the greater part of 2008, leading up to the Lehman Brothers bankruptcy, and went extremely negative following the Lehman Brothers bankruptcy in September of 2008. And it wasn't until about sometime in the first quarter of 2009 before U.S. yields rose back above German yields. And look on the far right-hand side of this graphic showing the yield spread over 5 years. It's the 10-year yield spread, but it's covering a time of 5 years. That yield spread went negative last week, and it's gone fairly sharply negative. So for what it's worth, when we have a financial crisis unfolding, and there's even more money flow into the U.S. than there is into Germany. In other words, U.S. yields. We saw back in 2008, especially after Lehman Brothers bankruptcy, both U.S. and German yields dropping, but the U.S. yields dropped faster than German yields. Hence this 10-year yield spread going negative. What was interesting and what was unique about last Wednesday, the yield spread went negative not because U.S. yields were dropping faster than German yields, but because you had a divergence between the two yields. The U.S. yield U.S. 10-year went down, and the German 10-year went up. Now, what does it all mean? Well, some think, and it's probably very premature, but some think this could be we could be near or at a tipping point for Europe. So, there's a lot of talk about how is it possible that this sovereign debt crisis this contagion, if you will, has spread to the point in where it's actually reached Germany. That's the idea being discussed, being touted, being really traded right now. Is Germany becoming itself a victim, even moderately, a victim of the European sovereign debt crisis? So I mentioned recently that Germany is one of the only remaining safe havens in Europe, and it's possible that's coming into question right now. Now, I wouldn't make too much of it. It's just a one-day event, and again, as I mentioned before, it's not the first time we've had a failed bond auction in Germany. It won't be the last, but it's something worth watching. Something worth watching. How yields in Germany move relative to the U.S. yields. So, for example, I would be watching, or I am watching, and will continue to be watching the likes of the German 10-year yield compared to, say, the U.S. 10-year yield. If on days when we see those yields moving in opposite directions, German yields up, U.S. yields down, that is very much a kind of day when you can be seeking opportunities to short the euro, especially if euro-USD price actually confirms that. By the way, anyone notice Italian 10-year yields back above 7%? Again, persisting above 7%. We closed today, I believe, around 7.25% on the Italian 10-year. Not good news if the Italian 10-year remains above that level, above 7%. Actually, the Italian 10-year is even it's not good news even if it remains above, say, 5.5% or 6%. But anyway, so looking ahead here, what are things to watch for? We have I believe an Italian bond auction tomorrow during tomorrow's London session. I would watch for that. Also, the ECOFIN meeting, we could have some news flow, some comments, some who knows, maybe something tangible for the market to chew on in terms of a next action, plans, or meaningful revisions to the EFSF, as I mentioned earlier, being discussed at this meeting of finance ministers in Europe tomorrow. So news flow out of Europe, plus related to the finance ministers meeting, plus the Italian bond auction. Two things to watch. Two things that could affect appetite for or against the euro USD, the euro in particular. Wednesday, I can envision Wednesday being an extension of whatever we get, or really even a reversal, depending on the case. It could be some sort of fall through to the whatever we get tomorrow from the euro, whatever we get tomorrow from the meeting of finance ministers. Thursday is the first trading day of the month, and with that we get a whole slew of different purchasing manager indexes from the likes of Asia and Europe and the U.S. These are manufacturing indexes. These are indexes based on surveys of purchasing managers at manufacturing firms in several different economies. We're going to get PMI numbers from likes of China, other countries in Asia, so-called emerging economies in Asia, PMI numbers out of Europe, and a U.S. PMI number published by the Institute for Supply Management, that's ISM, that during the New York morning session. Sometimes you'll see a risk-on or risk-off mood in the currency markets based on how good or bad those purchasing manager indexes are. That's Thursday. Also, actually, no, correction. I was about to say also Thursday, the ECB meeting. That's next week. ECB meeting coming up next week. So there's no major central bank meetings coming up Thursday, and then of course Friday the non-farm payrolls report. Yes, GAM, 80% GDP. GAM, actually, I don't know if I can drum that up real quick, but I've seen a graphic I found very helpful on comparing Germany to the rest of Europe. And, there's some arguments that, especially when you consider that the fact that Germany hasn't yet recapitalized its banks, Germany's fiscal position not as good as what many in the market would like to think, or or not as good as its reputation would suggest. But then again, you can make the same case for likes of, the U.S. or the UK. Just got to bear in mind that this is what the market does. The market will find something, some issue, some topic, some subject, some whipping boy to pick on, and that's what it'll do. It'll pick on it to no end until the whatever that trade is, whatever that theme is, it's run its course. And then it'll pick on something else. Oh, and always, keep an eye on news flow with regards to the European Central Bank. Thus far, Germany has been adamantly resistant to the idea of the ECB really stepping up its bond purchases in a big way. The European Central Bank, through its securities markets program, and launched last May of last year, European Central Bank has been buying government bonds, but they say it's in a sterilized way. I'm not seeing right now that the ECB is officially, or they officially are, but unofficially, European Central Bank are really not properly sterilizing these bond purchases. But anyway, on an official basis, they really are. But the ECB, to some degree, has not yet gone big. With a sort of a big bazooka type solution with regards to doing enough buying to stabilize the government bond markets for the likes of Italy or Spain, the likes of France. France calling for the ECB to step up their bond buying in a big way to at least stabilize the markets. Germany objecting to that, among other reasons, because number one, the Germans are very, very leery, very, very spooked about the prospect of future inflation. Plus, they're concerned about what's called moral hazard. The Germans do not want to provide too much help to the southern periphery of Europe, the likes of Italy or Spain, or especially Greece, these other countries, to the point where these countries won't be incentivized to shore up their government finances and to implement austerity programs and do things that could make those countries more competitive in the global marketplace. So does that make sense? It's like I don't know if I can compare this to like being a parent. You want to provide enough support. I got to be careful with this because this can stir up a lot of strong opinions about what's right or wrong when it comes to parenting or any other aspect of life. But you may think of it this way. So let's put it this way: some parents I know of parents who are concerned about, they want to provide enough help, enough support to their kids, but they don't want to provide too much support to the kids to the point where those kids are, won't help themselves and won't strive to improve themselves, and they get spoiled. To some degree, I guess that's a sort of an analogy when it comes to the way, right or wrong, the way Germany is viewing some of these countries in southern Europe, like Greece and even like Italy. They want to provide some. They may want to provide some help, but they're concerned if they provide too much financial assistance, there will be less incentive for the Greeks, for the Italians, to implement the austerity measures, reforms, and such that can help them over time. So again, puts it another way, and that's the argument. So that's the battle being fought by the likes of Germany and France right now. Is okay, and when it comes to a broad solution for Europe, it's many are thinking at least in the near to medium term that that's the most likely vehicle for something to help stabilize the government bond markets. The ECB has got to be a factor there. It's a thing amongst many right now. The ECB has got to be a major factor in terms of it's an entity that's already in place that has the firepower arguably needed, or at least can make the commitments needed to at least stabilize those bond markets. But the ECB is seemingly apprehensively doing its bond buying just enough to, if anything, stabilize the markets, but not enough to turn the tide of the markets. So the question is, will the ECB step in a bigger way? Well, that makes next week's ECB meeting very interesting. In fact, this next 2 weeks, folks, I would bring your A game. I would bring your A game to the currency market. You can say more broadly speaking this entire month, but this next 2 weeks especially could be very, very interesting for the currency markets, especially for the euro. I've already mentioned the Italian bond auction tomorrow, the ECOFIN, especially the ECOFIN meeting tomorrow, the meeting of economic ministers in Europe tomorrow. Not this Friday, but the next Friday, you have a meeting of European leaders on December 9th. And then the ECB meeting the day before that, December 8th. Again, many think, right or wrong, many think that if there aren't enough major steps on several fronts, by the way, not just with regards to can the ECB step up or not. If there aren't significant enough steps made on several fronts with regards to providing a broader, comprehensive solution to the European sovereign debt situation, then some think that the euro its days are numbered. I mean, not that the euro is going to go away, before the end of the month, but in terms of some real financial turmoil. Some think we're only days away from that, maybe weeks at most, and it could well be proved to be correct. Well, but whatever the case, whether the Europe does enough to stave off some sort of collapse or not, that it's and many think right or wrong is likely to be decided in the next couple of weeks or so. And Dan, I see your point there where Dan makes a comment about seasonal factors. Be very careful with the application of seasonal factors. Dan, let's put it this way: it's not every December. It's not every December that we're facing the market's facing the prospect of, will the euro survive? And for that, I take you to I can't show it. Well, I could show it to you, but you can go to there yourself. The Economist magazine. In fact, it should be in my mailbox as I speak right now. I haven't checked my mail yet today. The latest issue of the Economist magazine. The front cover of that magazine is essentially a euro in flames, a euro coin in flames, and some might consider that a bit of a contrarian indicator that maybe because everyone is so has such a dire outlook for Europe that maybe that. Again, if the European leaders surprise us, then it could be one heck of a short covering rally. Now, as we know, these short covering rallies have been very limited, very brief, and European leaders have just not done nearly enough to satisfy the markets. And we could see a repeat of that scenario, if not this week, then maybe next week. But I will say the situation is ripe for that. But so we're at a tipping point, and the market seems can tip either way, depending on what the Europeans do. And right now, the market seems to favor the idea, especially if you look at the European bond markets. The markets favor the idea of more negative news for the eurozone rather than positive news. But back to your comment about seasonal factors. Again, it's not every December that we see we're facing the prospect of the eurozone changing form forever. The 17 eurozone countries who have adopted the euro. I mean, that's what's in question right now. Oh, by the way, I was going to give you all of you something to chew on here. This is a graphic provided by the Financial Times, which I would not consider as gospel, but it is an interesting graphic that maybe helps some of you sort out, what could be the implications for the euro and trading the euro in the coming days and weeks. Let me show the graphic, and I'm going to see if I can upload it to the room here. First of all, someone confirm you see the graphic here. And Marco, I see Marco's comments about, Marco doesn't think it will fail. And that's certainly one of the scenarios, actually more than one of the scenarios depicted here. This is a graphic that I saw on the Financial Times today on their website. It was actually a graphic posted on a blog. The name of the blog was, I think, Gavin Davies. Gavin Davies had a blog about the future of the euro, and it was either he or someone from the Financial Times provided this graphic. It may not be comprehensive enough, and maybe pure, opinion and speculation as to the direction for the euro in response to these different paths. But it might be a good basis to start from when it comes to, what could happen on the euro based on different paths that the European leaders, and for that matter, all the European countries, the decisions that are made in the coming weeks. Let me see if I can upload this to the room. Or, or I could do actually, I think there's a public link for this. I believe the article itself was public. Let me see if I can track that down. Hang on. And I'll end on that note, by the way. I'm not certain, but I'm fairly sure that the Gavin Davies blog entry was public. So rather than just upload this, I can just point into the link, and you can not only get the graphic, but read the entire article. Yeah, it looks like it's still there. Now, I am a subscriber to the Financial Times, and I have full access to all the features and pages on the Financial Times website. But since this is a blog, that this graphic was obtained from. I'm thinking that anyone without, even those without a subscription can access this. Could someone please go to the link that I just posted and see if you can not only see the blog entry, but also see the graphic. So the graphic that I'm showing in front of my charts, that graphic is part of that blog post. And the blog post can be seen at the link I just posted. So someone please go to that link. I prefer obviously someone who is not a subscriber to the Financial Times, and see if that link works. So Gam, you confirm the link works? Good. Okay. Great. Thank you. So yeah, something to ponder there when it comes to prospective outcomes for the euro. And again, apologies for the technical complications earlier. I don't know what happened. Everything was fine on my end. I just lost access to Hotcom's Relay 10 server on which Forex Street has their room. But all is good right now. So I'll wrap it up with that. We'll do this again tomorrow. By the way, U.S. 10-year yield back below 2%. I'm back tomorrow. Yeah, I'm back tomorrow. Off Wednesday, back Thursday. So what can I say, folks? Keep an eye on Europe. These are interesting times, and this finance ministers meeting could be very interesting tomorrow. Good luck moving forward, folks. Cheers.